Hi, greetings from the world of finance. This is Professor Ravichandran from Bangalore. This session we will discuss how to estimate risk-free arbitrage in futures price. So when you estimate futures price using cost of carry model, so there will be the market futures price either will be greater than the estimated price or the market futures price will be less than the estimated theoretical price. When the market, so we are going to discuss two types of arbitrage: cash and carry arbitrage, reverse cash and carry arbitrage, and how to calculate them using some simple illustrations. Let's quickly go into and it's the basic concept. So as we discuss, either the market futures price, the futures price stated by the exchange, the market, either it will be greater than the theoretical estimated price or it will be less than that. So when the market futures price is greater than the theoretical price, we call it as a cash and carry arbitrage. So once we take arbitrage, then mean we have to take some certain actions. So and what are the actions that we need to take? We're going to discuss. So let's take a simple basic model of cost of carry to estimate the futures price of an asset. Let's say the current cost spot price is 1,000. The continuous compounding risk-free rate is 6%, and the time to expire is 3 by 12, and there is 3 months. So we'll calculate the spot price into exponential risk-free rate into the time, that is 3 by 12. So we'll get 1015. Let's say that assume the market price is 1020, which is greater than the estimated price. So as we discussed, we call it as a cash and carry arbitrage. So what are all the action that we need to take? The steps that we need to take is, first, since the market futures price is greater than the theoretical price, we say the futures price is overpriced. So that means short the futures or the futures price. And because we do overpricing, offsetting action the spot market by the underlying at the spot price by borrowing at risk-free rate. So let's quickly go into and the action and the cash flows that we take at time t0 at the inception as well as at expiry. So when you short the futures, there is no cash flows and it's just a contract. Then we want to buy the underlying at the spot. So we have to use the risk-free borrowed amount. So we borrow to buy 1 unit of asset of 1,000 rupees at spot market. We borrow the amount risk-free. So we buy the asset 1 unit. So the net cash flows is zero here. So at expiry, so we use a short futures. We sell the underlying, and at the futures price that is stated is 1,020. Now that is plus 1,020. Now we return the borrowed amount with interest minus 1,000 into exponential, the risk free into the time. So that is minus 1,050.11. Now the net cash flows here is nothing but the difference between these cash flows is 4.89. So this we call risk-free arbitrage profit. Okay. Now let's discuss the opposite. Let's say the same example. When the futures price, market futures price, is less than the theoretical estimated model price. Let's put it the and theoretical, that is a model price. Let's put the same price 1,050. There's no change here. Let's put the market futures price is 1,012. Since the market futures price is less than the theoretical price, we call it as a reverse cash and carry arbitrage. Again, we need to take set of actions. Since the market futures price is underpriced, we buy the futures, take the offsetting action of the spot market. And so when you sell this underlying at the spot market, we get some money, invest the money at risk-free rate of interest. So when it's long futures, there's no action, no cash flows. Sell the underlying at the and spot price. So we get the 1,000 as a proceedings as a in return, and we invest this and 1,000. So there are net cash flows of zero. Again, we'll take the set of action at expiry 3 months. So buy the underlying at the futures price. So that is given as 1,012. So minus, when you buy it is a cash flow out, minus 1,012. Again, receive the investment proceeds with interest. So that nothing but 1,000 into exponential RT, or risk free into time. So that is a plus. So the difference is the arbitrage. So this is called a risk-free and arbitrage using reverse cash and carry. Let's take a slight model, cost of carry model with a fixed storage and of paid at the end. Let's take this assume. Let's say the price of the gold and $1,800 per ounce. It's a spot market. Let's say the futures price is also stated, it is given, and the 3 months futures price given as 1,828. Now 5% continuous compounding risk-free rate. This is nothing but and 3 by 12. Now storage cost is to be paid at the end of the contract. So theoretical cost of carry model says first we have to calculate the present value of the storage cost, which is nothing but and 3 into exponential minus 5% into the time. So we got a 2.96. Now add the present value of the storage cost with the spot. So we get the adjusted spot price. Then we calculate what is called the 3 months futures price. So adjusted spot price into and exponential and risk free into the time. So we got the estimated theoretical price, and we already been given the futures price, which is slightly more than the estimated price. So we use when the market futures price is greater than the estimated price, we call it as a cash and carry arbitrage. Again, we'll do the same steps like the first basic model. To short the futures because the price is overpriced, no cash flows here. Then borrow risk free and equivalent to the spot market because we are going to buy the underlying and at 1,800. So there are net cash flows of zero here. Now on expiry, so since we sold the futures, we, we have to sell the underlying at the futures price, which is nothing but 1,828. Now that is plus 1,828. Now return the money, borrowed money with interest minus 1,800 into exponential risk-free rate into the time. Now, since look at this one, the action that we have bought the underlying and at the spot market, so we have to pay the storage cost at the end, that is minus 3. So that is given here. Now we have just sum up all the three cash flows. We'll get 2.36 as the risk-free arbitrage using the and this model. We can take the opposite. It's the same model we'll take, excepting the price will assume as 1,823, which is below the theoretical price. So as usual, we can say that the model price, that is market futures price, is less than the theoretical price. We call it as a reverse cash and carry arbitrage. So what is it when the market price is underpriced? So what we'll do, we'll buy the futures, we will sell the underlying. So when you buy the futures, there are no cash flows. When you sell the underlying and we get the money, so we have to invest the money that we got because of short sale. So we get to invest at risk free. So net cash flows is zero. So this is the and the return from the and short selling, and this is the investment that goes. So net cash flows is zero. Now at expiry 3 months, so we buy the underlying. So when you take long futures means as per the contract. So we have to buy the underlying at the futures price, which is stated as 1,823. So minus 1,823. Now proceeds from investment, which is nothing but 1,800 into exponential R into T 3 by 12, 5%. So that is it, 1,000. So there is a plus actually. So this is a plus. And now since we have a and what is the main action here? We have sold the underlying, we have avoided the storage cost. So the avoided the storage cost means there is a plus 3 here. So you add all the cash flows, you'll get 2.64 is the risk-free arbitrage profit, risk-free arbitrage from this model. When the storage cost is given in percentage, so how do you deal with this? That is a 3% on a continuous compounding basis. So as per the model, so we'll always calculate when the storage cost spot price into exponential and R 6% plus 3% and multiplied by time. So we got a 1,515.227. And let's assume, so it is given as a 520 is and the price market futures price. So it is more than the estimated price. So as a cash and carry arbitrage, as you know, the same thing that we give, sell the futures, buy the underlying by borrowed amount, and we get and the net cash flows is zero. Again, we'll do when you short the futures, sell the underlying at the futures price, that is plus 520. Then return the borrowed amount with interest, and that is minus 510 and 0.10. Now, since look at this one, we have bought the underlying, so that means we have to pay the storage cost. Here, the storage cost is nothing but, since the storage cost is given in continuous compounding, so we have to calculate like this. So, spot price into bracket exponential storage cost 3% multiplied by time and close bracket minus 1, enter. So that means this amount, so we have to and incur the storage cost, so we have to put a minus here. So that means we have to add the total cash flows, they'll become 4.87. So 4.87 is your risk-free arbitrage. So you need to be very careful. So when you are having a percentage, and that is storage cost is given in percentage or proportion, so this is one small adjustment you have to do. That means since we hold on to the asset and we have to pay the storage cost, and that calculation is nothing but spot price into and bracket exponential storage cost into time close bracket minus 1. Now, it's the same thing for reverse cash flows, same example, excepting we'll assume the market price as 512 instead of 520. So we'll say the market futures price is less than the theoretical price. So we'll say reverse cash and carry arbitrage. So that means buy the futures, sell the underlying. So buy the futures, no cash flows, sell the underlying, will get the money, invest the money. Net cash flows is zero. But at expiry, so that means when you buy the underlying, we have the minus 500 at futures price, which is minus 512. Now, redeem the investment amount with interest. That means 500 into exponential, 6% into time, 4 by 12. Now, again, the storage cost is avoided. How? Because we have sold the underlying, we have not bought the underlying. So, how you calculate here? So, again, the spot price into bracket exponential and storage cost is given. This is the 3% into the time close bracket minus 1, and so we had so this is avoided, there's a plus. So sum of the cash flows is and 3.13. So we have to be very careful, and whenever we are given the storage cost is given in a percentage. The last one we'll look into once, and when the income, the yield is given in percentage. So let's quickly go into, so how do you calculate? So let's say the market futures price is 512, 510. So how do you estimate the forward price when the, so nothing but we know that spot price into exponential bracket and 6% minus 2% into time. So you have to calculate like this. So now we got a 506.711 is your theoretical price, because there is a income of yield is given. Now always income is deducted. So if it is so we have to assume this yield is also a continuous compounding. So what is since 506 is greater than 510, so we have a what is called 510 is greater than 506. So we have what we call is cash and carry arbitrage. So that means the market price is an overprice. Short the futures, buy the underlying at the spot price. So short the futures, no cash flows. To buy the underlying minus 500, we have to borrow it risk free. So net cash flows is zero. Again at expiry, so short futures, sell the underlying at the futures price of 510. Then and return the investment and borrow with interest. That is 500 into exponential r into time. That is put a minus here. Then cash dividend received since we are bought the asset, so we got the dividends. So we have to add the dividends, so which is paid in a continuous compound. So how do you calculate 500 into bracket, and the first thing is exponential and bracket. So we have to and use exponential here, and assuming this is the yield into the time and close bracket minus 1. So it is nothing but so you have, since you have, so we have add all the cash flow. So the dividend here, the cash dividend that we received, we have to and we have to add it. So net arbitrage is 3.24. So this is how we need to calculate and cash and carry arbitrage, reverse cash and carry arbitrage. I given a few illustrations and hope you and enjoyed it. Thank you very much. Thank you. Bye.